All right, ladies and gentlemen, we are taking a look at Chapter 14. So, your work together and on your own are turned on. We're actually going to do two of them today because, well, it's short. But I want to talk about what we're doing in Chapter 14. Chapter 14 is the start of the end of the fiscal period work. So when we do accounting work, we go through and there are steps to the accounting cycle. We journalize, we post, and then we go through and get our end of the fiscal period work where we go through and create our financial statements. Some of our financial statements are permanent financial statements and some of them are temporary. The first financial statement that we prepare is called a worksheet. Worksheet has 8 columns. You have your trial balance, you have your adjustments, you have your balance sheet, and you have your income statement columns. We did those before. We're going to be doing it again because it's a little bit more complicated because now we have a merchandising business that's organized as a corporation. Now, when we talk about corporations, most people, if you think about the company like Apple or Nike, people like to invest in them. Why? They make money, right? Because they buy stock in them, and you hope that the value of the stock is going to go up. So what happens is the value of the stock can go up, but also corporations will go through and pay dividends to its stockholder. Have you ever heard about that declaration of dividends before by businesses? So what they will do is a business will go through and say, okay, we made a bunch of money. Now this money, the business can either hold on to it in their retained earnings because they're going to expand in the future, or they're going to give it back to its shareholders. And the business has to decide what they're going to do with it. Are they going to expand, give it out, or are they going to hold on to it? So in our example here in class, basically what's happening is through our corporation, the company had money left over, so they're going to go through and give that to its shareholders. They're going to declare a dividend. Declaring a dividend is different than paying it. So you will usually go through, and the stock market would go through and say, all right, today McDonald's is going to go through and give us their quarterly report. And with their quarterly report, they could go through and say they're going to be paying quarterly dividends. And different businesses will do it at different times. So if you're following the stock market, you will see that information where people are going to be anticipating how well a company is going to do. So what happens is you declare a dividend on one day. And when you declare a dividend, what you're saying is you owe your stockholders money. And we know in accounting, if you owe somebody, what type of account is being affected? Think about your accounting equation. A liability, right? So you're going to have a dividends payable account that you are going to have to go through and credit. So one day you're going to say, we're going to give this money to our stockholders. And then in the future, you're actually going to pay it, and it's not going to happen on the same date. And that's really what we're looking at for Section 14.1 right now, is going through and declaring and paying dividends, which is 2 journal transactions, why we're going to be able to get through 2 sections today within our chapter. So our directions read, we're working for Coastal Aquatics, and we're going to complete transactions during December of this year and January of next year. So on December 15th, Coastal Aquatics, their board of directors, went through and said, hey, we did really good. Every share of stock that is owned by our stockholders, each share of stock is going to get $3. Now, that doesn't seem like much, but people don't tend to own one singular share of stock. They own multiple shares of stock. So what we have to do is we look here and it says that we are paying a dividend of $3 per share, and there have been shares of stock. There's 1,750 shares of stocks that have been issued. So we can't just take one of these 2 numbers for our December 15th journalization. We're going to have to multiply it. So if you take 1,750 and multiply that by 3, you get 5,250. So that's the amount of money that the corporation is going to pay to its stockholders. So you can see this first transaction is recorded with an M, which means it's going to go in our general journal. So in our general journal, we're going to go ahead and put the date of December 15th. I already told you that we have to use the account dividends payable because we are declaring the fact that we owe this money to our stockholders. But there is also an account called dividends. Now, when we move from a sole proprietorship to a corporation, we no longer had Cole-Cuskey capital. Okay, we went through and we had capital stock, we have retained earnings, and we have this income summary. But we also now don't have Cole-Cuskey drawing. So in place of Cole-Cuskey drawing in a corporation, we have an account called dividends. Dividends is the amount of money that we are paying to our stockholders. So we're going to go through and use our two accounts, which is going to be dividends and dividends payable. So dividends is going to be debited because it's very much like our drawing account. It is a contra account to our capital stock. Our source document is going to be M162, and it's going to be for $5,250. Dividends payable is our liability, and it's going to be credited for the same amount, $5,250. So when a corporation, their board of directors, who are the people of the group that have been elected to manage the corporation by its stockholders, they go through and they develop and decide what's going to be done. That is the concept. Dividends can be distributed to stockholders only by a formal action of the corporation's board of directors. That is a business concept, a business entity. So that's going to be how it's going to be there. I'm going to guarantee that's going to be a question on your test because the multiple choice questions have been kicking your butts on the test. Declaring a dividend is the action by the board of directors to distribute earnings to a stockholder. The definition of dividends is earnings distributed to our stockholders. And the amount earned by a corporation and not yet distributed is an account called retained earnings. So those are new accounts that we're going to be dealing with. So we went through and calculated the amount of the dividends one day. Everyone's real happy. And now in the future, we just moved from December 15th to January 15th. We just did warp speed here. We have to pay it. So on January 15th, what account are we going to be debiting? What do we no longer owe? Dividends payable. And that is going to be check number 687 for $5,250. Go ahead and try on your own. Okay, so what are we doing in Work Together 14.2? What is this big thing? Worksheet. Now, I just kind of talked about the columns, but I need you to pause and think about the purpose of every column. What are we doing with our trial balance? It's the first thing you do, and if it doesn't work, you stop right there and don't do anything else. What are we trying to get? Debits and credits to equal. Beef stick or a sucker? What do you want? Beef stick. I know, that's a random thing. I'm like, beef stick or sucker? So, the whole purpose of a trial balance is to get your debits and credits to equal. If your debits and credits don't equal, stop and don't do anything else. The flavor you want? You go with it? Don't do anything else on your worksheet until that equals. Because if that doesn't equal, nothing else will come out and you're just wasting your time and end up having to erase and re-add and do things. Can't say it enough. Don't do anything else until the debits and credits equal. Don't do it. Okay? So we have some of the information has been filled in for us. Some of it has been not. So when we look at our directions, it says a partial completed worksheet for coastal aquatics is given below 4 general ledger accounts are shown. Your instructor will guide you through the following examples. So, it does tell us what line these accounts go on there, but they're getting a little tricky because they're not telling you if they're debit and credit. Go ahead and try to put them in there and determine, is it a debit or credit? You should know this already because these are all accounts we've worked with. And I say all the time, it has a debit normal balance or it has a credit normal balance. So, what you would do is you would go through and put in the account title. On line 3, it should say accounts receivable. You're going to put that value of $15,485.25 either as a debit or credit. I want you to do it, and then I will go back to you. Then you will go through and put in accounts payable. Then you'll do sales. Then you'll do purchases. I'm not showing you where I'm putting them on purpose. The next thing you have to do is this will take time. You take out your calculator and you add up your debits. Then you add up your credits. If they don't equal, you add again. You don't just go, oh, Mrs. Geisel, they don't equal. How many times did you add it? Once. Do it again. Because there's a lot more numbers. As our business gets more complicated, we have more numbers and it takes more time. So, break out that calculator, add her up. The trial balance, what we've just done so far, is not new. The only thing that is new is, well, our worksheet now has sense to it, and there's a lot more accounts to it. We have a new account on there this time, purchases. Purchases is a cost account, that is its classification, and it has what for a normal balance? Who said that? You already got a beef stick. Look, I just asked a question. Oh, see, now everyone wants a beef stick. Maybe you should pay attention. Kayla's got it up there. She rocked it. Purchases is a cost account. It has a debit normal balance. Otherwise, everything else that we've done in our worksheet is not new. So you shouldn't be like, oh, this is hard, because it's not. Yet. Okay? So, trial balance, debit, what did you get? Oh, Riley is really excited to give me an answer now. Oh, amazing. Oh, we should all have the same number. That's how accounting works. $1,109,585.56. Oh, it's 8. It should be 86. Oh, typo. Fat fingers. Good job, Nick. Thanks for pointing that out. And Riley. Okay. So trial balance, debits and credits equal. This just takes time. Okay? It's not hard. You're doing math. You use a calculator. Slow down. Get it done right. What we have to do next, dun, 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 is number 3. From a physical count of the following, December 31st balances need to be determined. Okay. Look here. Right here, does it say this is what we have or what we used? Physical count, what does that mean? That's what we have. Okay? So these numbers right here do not go on your worksheet. Don't go on your worksheet. What is the purpose of our adjustment column? What we use. The adjustment column is what we have used up. So throughout the year, let's say that I bought 70 cases of paper. At the end of the year, am I going to have 70 cases of paper left? Hopefully not, otherwise that was just a waste of my money, right? I buy paper to use in my printer, and then at the end of the year, I have to go through and count up to see what I have left over. So anytime I buy my supplies, my account supplies gets debited, and it gets bigger and bigger and bigger throughout the year. Would you agree? At the end of my fiscal year, I need to know what I have left over. And they just tells me right here that supplies office is $657.15. So at the end of every fiscal period, I have to go through and do my inventory and then adjust my supplies based on what I physically have left over. So in order to do my adjustments for supplies office and supplies store, which, okay, they're basically supplies, but just two different areas, and prepaid insurance is I need to know what I currently have. The difference between the two are going to be what we're adjusting for. So if I look at supplies office has a debit balance of $5,485.25. I would subtract $657.15. Is the value of my supplies going up or down? Going from $5,000 to $600. So I have to either debit or credit supplies. You guys are making me sleep. For how much? $4,828.10, right? You have to subtract those two. Now, hold the accounting train because I have a problem. I got a credit and I don't have a debit. So I have to scroll down. And when I scroll down, I have this account called supplies expense office and supplies expense store. So I'm adjusting supplies office right now, so I need to debit supplies expense $4,828.10 to account for what I've used up. So when I adjust on the top, I'm making the value of those accounts go down based on what we've used up. I have to remember to debit the expense account. These accounts, these supplies expense and prepaid insurance expense or insurance expense accounts should not have a balance in them. The only time we use them is at the end of the fiscal period when things are used up. So do the same thing for the two other adjustments. Okay? So you have to adjust the other supplies and you have to adjust prepaid insurance. But you do it exactly the same way. Finish up. It's the second one. Go ahead, rock it. Do it. Do it. Just do it. Oh, I'll beat you.